All right, 12631, it's Justin Wine here on Tuesday, November 16th, 2010. I wanted to give you an intraday update here. We're selling off hard today. We hit an intraday low of 1174, which from peak at 1227 2 weeks ago to trough thus far is roughly, by my math, about a 4.3% correction. Now, as I discussed going into this week, and actually in the weeks leading up to this here, at some point during this very strong uptrend, we were going to see somewhere in the neighborhood of a 3 to 5% correction. It could be a 4 to 6% correction, but the general area of 5%. I'm not trying to be wishy-washy, but 5% is kind of the general area. I was looking for a sharp, quick correction. I wanted to see some quick fear come back into the market, and I think we're really starting to get there today. Especially, it looks like we really did need to lose this 20-day moving average in order to kind of get some fear back into the market and humble some, I think, overly confident bulls. So we're in a situation now where, like I said, the game plan coming into the week was to be patient, but to look to eventually kind of buy the weakness here, because again, we still have this rising 50-day moving average, we still have a rising 20-day moving average, and like I said, these longer term moving averages are actually converging here and look to be on the verge of turning up. And like I said, this 1150 major level, which was resistance, is now looking to be like it would definitely be probably the last line of defense here. But I mean, I'm looking for this general area right around here, this 1170 area, maybe down to 1160 to hold. Like I said, by the end of this week, I think the 50-day moving average, which is actually already at 1165, it started the week at 1161. I think it's going to end the week and definitely in the 1170s, and I think we're looking for a nice, perfect test here of the 50-day moving average. I think we're seeing some key stocks pull back on lighter volume, which is I took a half position on Rig, Transocean. As you can see here, big volume bars on the way up. This was a major breakout here above the 200-day moving average, and then a retrace on light volume. That's what I want to see. And I know the PPT hybrid is still not oversold yet, but it is getting down there. The McClellan oscillator, another short-term oscillator, it's a bit different than a PPT. It's not quite as comprehensive. It's better for short-term trading, but plus 50 is overbought here, and minus 50 is generally considered to be pretty oversold. And right now we're at minus 54, so we're definitely very oversold. As you can see in late May, in the wake of the post-flash crash off to the left-hand side of the screen, it was extremely oversold, I think historically oversold. Then this is the July 1st bottom in the market, very oversold. The late August bottom before we started to rally, very oversold. And the only time we really got overbought was in the very early stages of rally. So we kind of moved up throughout the rally without this ever really getting overbought again. So my point is that what you're looking for in a bull market correction is a quick shake, something that brings the fear back into the market, but more importantly, something where it gets oversold very quickly, like we're starting to see now. And if you notice in a bear market, even though you'll see a lot of selling, it takes a whole lot longer to become oversold. Whereas in a bull market, becoming oversold is that happens quite quickly. Just like in a bear market, the flip side of that, it's so easy to become overbought in a bear market. As you can see, at various points throughout the summer when we were in that trading range, you can see how quickly we became overbought. That's the nature of a market, I think, that's actually not healthy, is you become too overbought too quickly. Whereas in a market that's healthy, you become too oversold too quickly. So according to the McClellan oscillator, we are definitely oversold. But like I said, you'd like to see the PPT confirm that. But either way, I think, I'm definitely looking for the S&P 500 to find support here at this 50-day moving average. Now, again, you always want to have a point where you're going to admit you're wrong. If the 50-day moving average and if this 1150 level, if they fail to hold, I mean, I think that I would definitely have to reevaluate many of these assumptions. But at the same time, we still have this 1130 level, the 200-day moving average, and to be sure, and the 200-day moving average is right at just about 1130. If we lose that, then I think that's when you really have to reevaluate everything. But until then, we want to play the probabilities here, and I really think we're starting to see a shakeout, and I think the 50-day moving average should hold.